Here is the thing about financial advice that travels in packs. It sounds authoritative because so many people are saying it at once. You hear it from the person sitting next to you at work, from a podcast running in someone else's earbuds, from a relative who leans across the dinner table with the satisfied confidence of someone who has already solved a problem they assume you share. The advice is usually delivered without a single question asked about your situation, and yet it arrives with the full weight of certainty. The Roth IRA versus traditional IRA question is one of the most reliable places this dynamic plays out. The advice almost always comes down on one side with great conviction. Go Roth, most people will tell you. Pay the taxes now, let it grow tax-free, never pay again. And for a great many people, in a great many situations, that is genuinely reasonable thinking. But it is not a law of nature, it is a bet. And the odds of that bet shift dramatically depending on facts that are yours alone. The core question is not complicated once you strip the noise away. A traditional contribution lowers your taxable income today. A Roth contribution does not. When you withdraw in retirement, the traditional account gets taxed and the Roth does not. So the whole decision pivots on one hinge. Will your effective tax rate be higher now while you are working or later when you are drawing the money down? If you are in a high bracket today and expect a quieter income in retirement, deferring the tax makes mathematical sense. If you are early in a career earning modestly and expect your income to climb for the next 30 years, paying the tax now on a small number is likely the better trade. That is the reasoning. It is not mystical. But here is where most people go wrong. They skip the reasoning entirely and just adopt the conclusion they heard most recently from someone who seemed confident. They take someone else's answer to someone else's question and apply it wholesale to their own life. The old speculators had a name for this kind of borrowed conviction. They called it acting on a tip. Livermore understood that the damage a bad tip does is not purely financial, it is cognitive. The moment you accept someone else's conclusion without doing the underlying thinking yourself, you have surrendered the one real advantage an individual has, which is intimate knowledge of their own circumstances. Nobody else knows what you earn, what you expect to earn, what state you live in, whether you have a pension waiting, whether you are likely to inherit, whether you will work past 65 or burn out at 52. Nobody else is living inside your tax bracket. Not the podcaster, not the colleague, not the well-meaning relative, and the future is genuinely uncertain. Tax law changes, income changes. Congress has moved brackets before and will move them again. That uncertainty does not mean the question is unanswerable. It means the answer has to be built on your best current reasoning, revisited as your life evolves, not locked in because someone spoke with authority in your direction once. The practical rule is this. Before you choose the account type, write down your honest estimate of your tax situation now and your best projection of your situation in retirement. If you cannot do that yourself, find a professional who will ask you those questions directly rather than one who hands you the same answer they hand everyone. The question deserves your own thinking because it is your own money and ultimately your own life the answer will shape. Most people get this wrong in the same direction. They hear a confident voice, a podcast host, a colleague at lunch, a comment thread that somehow attracted 300 upvotes, and they take the answer wholesale as if the person handing it down had any idea what the next 30 years of your income, your marriage, your health, your legislation, or your ambitions actually look like. They do not. And the advice costs you nothing to give and sometimes a great deal to receive. Here is the tension at the center of the Roth versus traditional decision. Both accounts shelter your money from a certain kind of tax. They simply disagree about when. The traditional account takes the deal now, you get the deduction today, you pay the tax in retirement. The Roth takes the opposite bet. You pay now, you walk away clean later. One of those is better for you. But which one depends entirely on a question nobody can answer with certainty. Will your effective tax rate be higher during the years you are earning or during the years you are spending down what you saved? That is not a rhetorical question. It is the only question, and the honest answer is that it varies. A young person early in a career earning modestly now and expecting income to climb has a reasonable case for the Roth, pay the low rate today and let decades of compounding accumulate tax-free. A person at peak earnings, already in a high bracket, stacking income from multiple sources, has a reasonable case for the traditional take the deduction now when it is worth the most and plan thoughtfully for what retirement distributions will actually look like. Neither answer is universal, neither is a tip you can hand to a stranger. Livermore understood something about tips that applies here with almost uncomfortable precision. The person offering the tip is not wrong to have an opinion. They may even be right about the general shape of the thing, but they are never inside your position. They are never carrying your specific exposure. The advice that is correct in the abstract can be ruinous in the particular, and the particular is where you actually live. Most people get this wrong because they outsource the reasoning before they have done any of their own. They want a clean verdict. Roth wins, the internet says, so they open a Roth and feel finished. But a decision this durable, one that will compound in either direction for decades, deserves more than a borrowed conclusion. It deserves a few honest questions. What do I actually earn right now? What is my tax rate today, not in theory, but on the last line of a real return? What do I expect my spending to look like in retirement? Do I expect tax law to shift against me? Do I have other income that will follow me into retirement, pensions, rental income, required distributions from other accounts, that will fill the lower brackets before I ever touch this money? Those questions do not have universal answers. They have your answers. The practical rule is this: make the Roth or traditional decision as a deliberate act of reasoning about your own projected tax life, not as a default, not as a trend, and not because someone you trust made it sound simple. It is not simple. It is one of the more durable financial decisions you will make, and it compounds. Get the reasoning right, and the account will take care of itself for 30 years. Borrow someone else's reasoning without examining it, and you may be paying for that borrowed confidence for just as long. The most dangerous piece of financial guidance you will ever receive is the kind delivered with complete confidence to a room full of strangers. It sounds authoritative, it sounds generous, and it fits nobody in particular, which means it fits everyone badly. Think about how often you hear it. Someone on a podcast, someone at a dinner table, someone in a comment section under a retirement planning video, and they say, always max the Roth, or always take the traditional deduction, as though the answer were a law of physics rather than a function of your specific income, your specific future, and your specific guess about where tax rates are headed. They are handing you a map to a city they have never been to and calling it directions. Here's what is actually true. The Roth account and the traditional account are not competing products where one is better and one is worse. They are a wager. A Roth is a bet that your tax rate in the future, when you pull the money out, will be higher than your tax rate right now when you put it in. A traditional account is the opposite bet, that you are paying more in taxes today than you will pay in retirement, so you should defer. That is the whole mechanism. There's nothing more complicated than that at its core. In the moment you understand it as a wager, you realize why no one can make it for you. They do not know what you earn. They do not know what you will earn. They do not know whether you will retire at 55 into a modest lifestyle or at 70 still pulling income from a business. They do not know whether tax rates will rise, fall, or restructure entirely in the decades between your contribution and your distribution. They are guessing, and they are guessing about someone else's life. Most people get this wrong in one of two ways. The first is paralysis. They find the uncertainty so uncomfortable that they make no decision at all, which is itself a decision and usually a poor one. The second is false confidence. They hear one rule of thumb, apply it without examination, and feel virtuous for having followed advice, even if that advice was never meant for their situation. The failure mode to watch most carefully is this. Someone gives you a Roth recommendation because they are in a low tax bracket themselves, or because they read that tax rates are likely to go up, or because some general principle about tax-free growth sounds appealing. All of that may be true for them. None of it may be true for you. Livermore understood something essential about the danger of borrowed conviction. He believed that a man who acts on another's opinion is not really trading. He's just lending his money to someone else's thinking. The same holds in personal finance. When you follow a blanket rule about retirement accounts without running it against your own numbers, your own income trajectory, your own state taxes, your own expected spending in retirement, you are not planning. You are delegating the thinking and keeping all the risk. So do the work. Sit with your actual tax rate today. Make a reasonable estimate, humble but honest, about where you land in retirement. Consider whether you expect to have significant taxable income in those later years or almost none. Consider whether you have the option to split contributions between account types and reduce your exposure to either bet going wrong entirely. No one is living inside your bracket. No one else is making that withdrawal in your name. The thinking has to be yours. There is no asphalt boulevard to success in Wall Street or anywhere else. Why additionally block traffic? More wisdom for the patient speculator every week at charthorizon.com.